Good afternoon and welcome to the Winter 2022 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the CRE business since 2009. We are pleased to have an insightful program for you today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which for those of you who do not know is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform and we'll do a couple of housekeeping items just to make sure everybody's comfortable. On the audio front, all the participant audio is muted, meaning we cannot hear you, and that's by design and that's going to remain the case. If you're attending by computer, take just a moment to familiarize or reacquaint yourself with the control panel elements. We will be showing the slides, but if you would like to download them, you can find the handouts section of the control panel and click on the file name and it will download. Naturally, since we're going to be showing the slides, you don't need to have them up, but you're certainly welcome to keep them for future reference. As always, we've reserved 15 to 20 minutes at the end to answer participant questions, but please feel free to submit your questions at any time by clicking in the questions field, typing in your question, and make sure to click the send button. If at any point you get disconnected, just reconnect the same way you did originally. If you are registered, you will automatically receive an email link to the recording of the webinar about an hour after the completion of today's session. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, over to you, and we have a familiar creature in front of us here on the screen.
Yeah, well, thank you, Bruce, and welcome everyone on a blue but very crisp day in Philadelphia. I think we could do this seminar really quickly if you wanted, Bruce. No, I'm not terribly worried about inflation. Yes, interest rates will go up and you won't die. And no, I don't think cap rates will go up when interest rates are up. I think that covers everything, doesn't it, Bruce, in a way?
Yeah, but don't sell yourself short, Peter.
So, the first slide was the butterfly, and I had talked about the butterfly recovery, and I think it's finally over. There's issues going on, but the first slide up that you're looking at now are COVID deaths. You can't see it as dramatically as has happened, but what's happened is COVID deaths never went up to quite the same degree here as in the past, and also they have fallen dramatically. Up until this wave of Omicron, there were always some people who were categorized as dying of COVID, who in fact had many other factors that were probably more responsible for their deaths. That has even been more true with cases and hospitalizations and deaths this time. There have been a couple of studies that have shown that imagine you are in a traffic accident, a bad traffic accident, you go into the hospital, they're going to test you. You don't know you have COVID, they find you have COVID, and now you get reporting issues. Now that's always been the case, but given how mild relatively Omicron has been, and given how widespread it has been, most of the hospitalizations and most of the deaths are not uniquely attributable to COVID. And the fact that this is coming down, has come down dramatically. You can only see at the very far right of the chart. It's really down dramatically. And when you realize versus even June of last year, which was a low point, it's pretty much approaching that in terms of COVID per se. If you go to the next chart, let's look at how the economy is done. And we have unemployment in the red for teens, and we have unemployment for everybody in the economy in blue, and we have the averages just put there to help your eye. Teen unemployment remains at incredibly low rates, which tells you strong labor market for anybody who wants to work. Now, interestingly, there's not as many teens as a percent of the teenage population working as back in the 60s and 70s. Not as many teens work these days, but any teen that wants to work, pretty good opportunity to find a job. The unemployment rate among the whole population, as you can see, is back down near the lows we've achieved before after these enormous spikes. However, remember that the unemployment rate is calculated as people saying they're unemployed divided by people who say they're unemployed and those who are employed. Well, if the labor force gets low because a lot of people drop out, it can be deceivingly low. And in fact, if you go to the next chart, you'll see employment as a percent of the so-called working age population. And again, the red is the average, just to help you help your eye achieve what you're otherwise trying to do. And you can see how the participation rate among the working age population plunged and has come back, but it's not back to where it was. It's sort of back to where it was 2016, but not where it was at the end of 2019. So we still have a good distance to go in terms of bringing people back into the labor force. By the way, go to the next chart. You can see it in another way. And this is the labor force in absolute numbers, not as a percent of the population, but in absolute. And again, the red line in this case marks the pre-pandemic high, again, to help you see. And you can see that we are back within about a couple of million of where we were to start with. So if you think about it, the unemployment rate is not much different, but we've got 2 million less people in the labor force, and the population grew over that time. So when you do all this, labor market is good if you're actively wanting to work. What it's not doing so well is if you're marginal about whether you really want to work or not. It's not pulled all those people in. The biggest group that has dropped out, probably 3/4 of this 2 million drop, are people who are 62 and older, or were 62 and older when the pandemic began 2 years ago. Hard to believe, but 2 years ago, basically, when the pandemic began here. And I said at the time that those people were going to, if they lost their jobs, they weren't coming back. They were a couple of years away from retirement, and they just called it quits. They collected unemployment insurance or any severance they might have gotten. They're not coming back. So a big chunk of this down are what I would call mature or classic age population that would have otherwise still been working, but after having lost a job for a year or so, it's just not worth it, especially given they were able to collect unemployment insurance, and in many cases, unemployment insurance that paid them more than they were making. They've just called it quits. That is temporary, though, because the new 62-year-old will work. The new 66-year-old will work. It's the ones that got the shock. So that's largely where the phenomena is concentrated. Go to the next chart, real GDP, the red. Whenever I say real, we're simply taking adjustments for inflation. The red is the pre-pandemic peak, which would have been fourth quarter 2019. And we're basically at that number. In fact, it's 3.2% above the peak, but the thickness of the lines make it hard to see. But you can see the blue is just above, 3% above. Now, If you go to the next chart, you might, by the way, you might say 3.2% above, pretty amazing. If you go to the next chart, you'll see if we would have grown at about 2.5% a year in real terms for the last 2 years, we're actually about 4% below potential. So, or 3.5% below potential. Another way to say it is, people will ask me, what's the most impressive thing, what's the thing you've learned in the 2 years since the pandemic began? And one of the comments I make is the power and resilience of the American economy. You could shut down 35 to 40% of the economy completely for 4 months, and parts of it for even longer. And 2 years later, GDP is 2% ahead. Employment is roughly the same. I mean, that's an amazing statement. In the meantime, not only do we have the shutdown and the phenomena of COVID and all the concerns about whether to travel and this and can I work and deaths, and you had political turmoil, you had social turmoil, you had geopolitical turmoil. That's pretty amazing that GDP is, after 2 years, ahead and not ridiculously behind where it should be. And in fact, if you go to the next chart, you can see kind of that strength. It's new weekly unemployment insurance claims. This is a remarkable chart when you think about it, in that this is thousands of people applying for new unemployment insurance claims in a particular week. And you can see all the history back to 1967, including very bad downturns in 73 and again in 70 and in 80 and 81, and obviously the financial crisis. And the spike that occurred related to the shutdown just made you rescale everything by a factor of 10. I had to rescale this chart by a factor of 10 or 11 just to fit it in. Now, on the other hand, you can see that claims are low again. They're back down to the 200 to 230,000 a week range, which is quite strong data. If you go to the next chart, I just wanted to focus on private sector. Private sector employment is almost, not quite, almost back to its previous high, which I mark in red. It's just below it. You may recall that we kept saying when the federal unemployment insurance top-up ended in the first or second week of September, you were going to see a lot of jobs added. People were saying, no, 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 they'll never come back, they'll never work again. I said, that's nonsense. We've added slightly over 1 million jobs since the top-up ended, and we will continue adding more. The economy is in pretty good shape that way. There's still a lot of bouncing around and a lot of turbulence, but the job market looks good. Go to the next chart. Real household wealth. The red is a trend line. The blue is where we actually are. And yes, even after the turbulence in the stock market in the last couple of weeks, we're still at record high wealth. Households are really well off. Now, you have to remember that what that really says is that if you had wealth, it's gone up. However, if you never had wealth, think of a 19-year-old, or think of yourself when you were probably 22, when you had no wealth, your wealth has not gone up. So in a way, this understates how much wealth has gone up for those that had any degree of wealth, and obviously overstates it for those who never had wealth. And so there is a sense that the wealth is well up. The ones who had no wealth and still have no wealth are no worse off after the 2 years. And the rest of the households are much better off at this point and feel pretty good. Go to the next chart, and what you'll see is whether you measure debt burden as what's household debt relative to disposable personal income, that's the red. And that peaked during the run up to the financial crisis. And we're back down to levels of the 70s and 80s in terms of household debt relative to personal income. And if you view it in terms of how much is our savings relative to disposable personal income, you can see it skyrocketed, the blue skyrocketed. That is, people saved like mad. That was that involuntary savings we talked about. I got refunds on my vacation. I got refunds on my basketball tickets. I couldn't go to restaurants, et cetera, et cetera. There was a huge spike in savings. And now that is normalizing back down to pretty much normal, so that the savings rate is pretty typical, still a little high, but pretty typical. So people are savings. They had a period of savings, and that's one of the reasons the wealth went up. And they have low debt relative to their resources. Check on the retail sector, which you might suspect is doing quite well, given jobs are strong, GDP strong, savings are strong. So this is real e-commerce sales. And you can see the trend back to 99, which was essentially nothing. You can see that it pretty much has been going up. It had a little dip during the financial crisis and has been on a great path. And you saw the great spike that occurred. And in the first month or two of that spike, most people were saying, oh, it's over for brick. This is a jump start. It will zoom, accelerate, go out of sight. It's going to eliminate brick altogether. And I kept saying, no, it's that brick is shut. Brick was not allowed to operate. And you eliminated the competition. And my premise from day one as this happened would be, it would then normalize. And what you've seen is that after that big spike, it is essentially flatlined, which is to say it's going up at about inflation, but they're not getting much more throughput. At the same time, go to the next chart, real sales going through bricks. These are the ones that were going to be dead, and I've got the red line marking the pre-pandemic high. Remember, these are real sales. These are adjusted for inflation. And you see the huge drop, and that was offset by a spike, or partially offset by a spike. Only a small part of it was actually offset by a spike in online sales. And I said, you know, this is going to come back once people can shop again. Well, you can see that real brick sales are at an all-time high, which is to say people enjoyed the shopping experience. Not everybody, but enough people. And I find it funny, every time I go to a shopping center, it's full, it's active, it's busy, and I go and I laugh saying, oh yeah, nobody's ever going to shop again. It's crazy. So bricks are doing fine. The online is doing fine. Now, if you look at it, this is one of the most accurate predictions I've ever made. And I don't make many accurate predictions. So when I do, I like to point them out. And the red line is a crude trend. All I'm trying to do is help your eye put in. Don't make specifically anything of the red line. It's just trying to help you do what your eye would be doing if I didn't put the red line in. That's kind of the crude trend in online sales as a percent of non-auto related retail sales. And my statement was always that when the spike occurred, the share that was going to online was going to go up, and then it would normalize back down to trend. Well, that's pretty much is what's going on. I think by the end of the year, it will normalize back down to about the trend line. Now, note the trend line is positive. So part of it is happening by the share falling, but a bigger also part of it's happening by the trend line coming up. Now, what I think happens is once it gets around the trend line, it will resume its upward climb as a percent of sales. But all this is normalization. And I think 2022 is going to be, with hindsight, the year of normalization. Normalization in, oh, I'll go back to work. Normalization in the way I shop, the way I travel, the way we go to sporting events, the way we eat out, the way we interact with our families, the way we shop, the way we do all sorts of things. This is going to be the year of normalization. Maybe not perfect normalization. You'll see supply chain normalize through the year. You'll see capacity normalize through the year. So this is one of the normalizations that will continue, and by the end of the year, this one should be pretty much over and go back to trend. Speaking of normalization, go to the next chart. Where are we in terms of going back to the office? Well, it depends on where you're at. If you're in Texas, probably 50% of the people are back in the office. If you're in the Northeast, probably 35% are back in the office. If you're in California, probably 25% are back in the office. All of these are a bit higher in the suburbs than the city. Probably overall, some number 45% or so are actually showing up back in the office. If somebody made me pick a number to put in the first line of this, when we meet a year from now, I'm going to say about 85% back in New York and about 95% nationally. I just think people come back. There are productivity and competitive advantages associated with the office. Doesn't mean there might not be more flexibility, but there was already a lot of flexibility. Social interaction, office politics, yes, working at home saves the commute, but working effectively at home, if you're honest, requires self-discipline, self-motivation, and a conducive work environment. That's a relatively rare combination. That's why I think people come back. And big Ricky Gervais fan. If you haven't seen his new series on Netflix, Afterlife, there are 3 seasons there. I highly recommend it. He's very observant, and he was the creator of The Office. And his premise was, even when people are at work, it's hard to get them to really work. And I could only imagine if Ricky Gervais created a series called Home Office, what that would look like. And I suspect it would be spurts of greater productivity, but spurts of bizarre unproductivity. And any of you who are fans of the old comedy series The Office, either the British or US version, know what I mean in that regard. How about hotels? Again, I think this is a year of normalization that we've just embarked on in 2022. Domestic travel is solid, not great, but solid, still well below previous peaks. RevPAR at hotels was about, in US, was about 83% of the December 2020 number, but people are traveling. They do want social experiences. They do want entertainment experiences. Ultimately, the business advantages of face-to-face will out. People enjoy leisure experiences. In April, my wife and I and some family go down to Disney, Orlando, not just Disney, but Orlando for a week. And it's pretty tightly booked. And so people are looking for that. I haven't been to Vegas, but people tell me Vegas is quite active again. The shows are back, et cetera. Convention business even trickling back. International is open again. I was in Germany for a couple of weeks earlier this month and late last month. It's open, still light. Let me give you just a number or an example to give you a sense. There used to be 5 flights a day, 7 days a week between Philadelphia and Frankfurt, Germany. there were 3 flights a week in up to January, and in February and I think March there are 0. So it gives you a snapshot. Now, obviously, what that does is mean the planes are full, more full in New York, as they push people there. But you get a sense from that little snippet of what things look like. Labor shortages still remain an impediment for hotels hitting full service, but improving. I think it'll be a good year, and I think by the end of the year, you'll see a huge upswing in international. Big exception will be China. Anything related to China demand is going to be at least a year or more behind. Multifamily status. The urban core is absorbed. The excess pipeline that was existing 2 years ago has been largely absorbed. The decline in the renter population in the urban core happened exactly as we suggested it would, which was anybody who was going to leave in 2020, 2021, or 2022 left the urban core in 2020. However, they've already left, and 21 turned out to be a very strong year. I think 22 will be a very strong year because there are people moving in and nobody moving out because the people who were going to move out have already left. Suburbs remain strong in general. The involuntary savings, remember back to the savings chart, that spike, and the COVID inheritances. Remember, the COVID inheritance were your grandparents or parents died 5 years earlier than otherwise would have occurred from the first couple of waves of COVID, and you inherited, and that allowed you to make the down payments. As involuntary savings, or savings have normalized, involuntary savings disappearing, and COVID inheritances disappearing, thankfully, as people don't die prematurely, mean that is going to normalize the home ownership rate. There are good demographics for multifamily, namely, for every millennial moving out, there's a Z moving in, is a crude description. So it's a pretty flat demographic, so it's pretty good. There's a fundamental supply shortfall of multifamily housing and a dramatic shortfall of single family housing, which is a competitive alternative, and that's why home prices are so high. And with high home prices, there's a lot of people priced into renting, even if only for another couple of years, and I don't think that changes. And there's a limited supply outlook. The supply is not low, but it's not going to catch up with the shortfall for several years. So in December of 2020, I said we were entering a golden era for multifamily. I still think it's a golden era for multifamily, a little less glittery. Why is it a little less glittery? A lot of the things I saw, namely in terms of capital movements, cap rate compression, have already occurred. I still think you have a little more cap rate movement over the next several years. But I still think you're in a golden era. It's just not as golden as it was at the end of 2020. Go to the next chart, warehouse. Strong demand continues, really strong demand continues. It's driven essentially off of the economy rebounding, but also that every online sale takes about 3 times the amount of warehouse space as if that was sold in a store. And so when you have high and ultimately back to trending upward numbers, remember that online sales number was big jump and then flat lining coming back to trend as things catch up. So a 3x factor is a lot of demand. Supply is increasing, but you need it to grow at about 4% a year. 4% of the existing stock a year has to be created to keep up with that demand growth, and it's not achieving that. The other thing that's happened is it's clearly become an institutional investment class over the last 5 years. And actually, in many cases, a preferred institutional investing class. And as a result, lots of money pouring in, and strong pricing continues. Go to the next couple of charts on pricing. These are Real Capital Analytics, RCAs, private real estate values in a per square foot. These are real. These are adjusted for inflation. And you can see that office squiggly flat probably for the last few years, down from a peak, but kind of flat, not off the face of the earth. It's rebounded a good bit from what happened at the bottom of the crisis. If you go to retail, retail's well down from its peak in the 15-16 period, but pricing reasonably solid. The story there is good retail does really well and weak retail does really bad. And there is a lot of bad retail that pulls the average down. And then you look at industrial and you can see it's just gone up, up, up. And that pricing has been driven by NOIs going up, up, up for the reasons we just discussed, as well as cap rates coming down. And for the reasons we'll discuss in a moment. And then go to the next chart for multifamily and hotel. You can see hotel in the red, obviously always been a volatile valuation sector compared to the others. Probably peaked around 2015-16, has come down notably, plunged during the early part of the COVID shutdown, but has largely recovered back to where it was pre-COVID from a pricing point of view in real terms. And then multifamily, up, 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 NOIs going up, cap rates coming down. Any temporary drop associated with COVID has been more than reversed. So pricing is good there, lots of money. Go to the next chart. I use REITs here for cap rates only because their data is so transparent relative to private markets. And if you look at the second quarter of 2020 versus the fourth quarter of 2021, cap rates multifamily down substantially. Cap rates on shopping centers down a bit. Cap rates on malls down a bit, a good bit. Cap rates on office even down, and the cap rates for industrial down a good bit. So when you look at it over a sort of bottom of COVID, which is the blue, to today, you get a sense of recovery in cap rates that occurred. Go to the next chart, just a reminder when you think about values. When you go back to 2020 and you think about values, you were looking at bad cash flows, particularly in several sectors, for the next couple of years. Well, those worst cash flows are behind us. They no longer drag down values. Discount rates have fallen. If you think about discounted cash flow, they have fallen as reality is set back in. People have come back to shopping centers. People have paid their rent in multifamily units. We still need boxes in warehouse, and people are still going to hotels. And as that occurred, the risk fell, and the perceived risk fell, and discount rates fell, increasing value. There have been, and I'll show in a second, staggering liquidity injections over the last 13 years, and certainly over the last 2 years again. And that those liquidity injections, or part of those, will chase assets, bid up prices, bid down cap rates systemically, much as they did during the 2010. I still don't think greed is winning out over fear. There's a lot of fear in the world, and I would say that simply because there's record amounts of cash holdings and record amount of dry private equity money and record amounts of unlent reserves at banks, which is not what you'd expect if greed was rampant. That's more what you'd expect when there's still a lot of fear in the world. So greed is still not winning out. So I believe values will rise notably as some of that money comes off the sidelines, and you still will see further cap rate movement downward. What happens as rates rise? Well, what happens as rates rise is the same thing that's going to happen in the past as rates rise. vis-a-vis cap rates, which is nothing systematically in the relevant time horizon. And we've written about this in Linneman letter, and Matt Mariva and I have published research on it, and we will have another piece in the upcoming Linneman letter on it. You just don't find a correlation in any relevant period between cap rates and interest rates. And if you don't believe it, what's happened to cap rates in the last 6 months or year versus interest rates over the last 6 months to a year? Well, if anything, cap rates have come down as interest rates have gone up about 70 basis points. Long-term interest rates have gone up 70 basis points. My research, and I think common sense, and we argue this in Linneman letter, basically says it's the weight of money that determines what cap rates are. And as long as there's plenty of money seeking a home, cap rates will tend to stay down. In that regard, a couple of just charts. Go to the next one on federal debt per household, up, right? This is debt per house, US debt, federal debt divided by the number of households. This is the implicit debt we owe ourselves. It's not quite what we owe ourselves. We owe 200, I'm just rounding. Each household owes 200,000. If we put up 200,000 per household, we could retire the federal debt. But remember that about half of that money would just go back to US citizens. So a more net number, a net number is more like 100,000. Namely, we pay ourselves 200,000 and we get about 100,000 of it back, and 100,000 would go to people overseas. Go to the next chart, you see the federal budget, revenues and expenditures broken in different eras. And you can see two patterns here. One is that the expenditures goes up a lot more secularly than does the revenue. On the other hand, we're doing quite well currently in terms of revenue. We're collecting about 17% of the economy, which is actually high by historic standards for the federal government, and the deficits are coming from the spending side, not from the shortfall of taxes. And then just one more chart. I just find this interesting. This puts federal debt as a percent of GDP. And you can see it's basically the equivalent of World War II. It's kind of remarkable. And by the way, the other high debt levels generally were coming out of the Revolutionary War, coming out of the War of 1812, coming out of the Civil War, coming out of World War I, World War II being staggering. And then you can see today. So this is a big change. Now go to the next chart, and we wrote about this in the last Linneman letter, so you can read it in more detail. The top, this is federal debt outstanding, and you look at the blue line, and that's total federal debt outstanding. It's about 27 trillion. Right now, up from about 6 trillion in 2020. So 20 years it went up by more than $20 trillion, okay? The yellow line is net of debt that the government owes other agencies within the federal government, most notably Social Security. So if you net out intercompany debt, which is a sensible thing to do, it's not really 27 trillion, it's more like 22 trillion, because 5 trillion of the debt is the government owes it to itself. And so that's a left hand, right hand. The third is, and by the way, the debt held by government agencies is the green line below. That's what's subtracted out to go from the blue to the yellow. The third line is, well, wait, there's another government agency that owns a lot of debt, and that is the Federal Reserve. And you can see the pink line all the way to the bottom. That's debt that the Federal Reserve holds. Now, technically, it's an independent agency, not the federal government, but for all intents and purposes, it is the federal government. And you can see how the pink spikes, really spiked 2 times. It spiked back as you came out of the financial crisis, 2010, 11, 12, 13, 14, right? You see how it's moving up, and then a really fast spike in the last 2 years. Well, in the same way you'd net out money the government owes to itself, you should net out that Fed debt. Namely, this is money we owe ourselves. And the red line is federal debt that we really owe, not the government owing to itself. And you can see that's risen, but it's not as crazy as what the rise has been because the Fed has been such a big buyer. And just for a round number, think of about 40%, about 50%, excuse me, of the red line is owed to US citizens. So, and the other half is owed to foreigners. So you can think about it, gee, it's only half as high as it might appear. Go to the next chart. Money supply spiked. Big spike in the money supply. Go to the next chart. The consumer price indexes for core, services, and all items. Well, the interesting thing is all items have gone up more. That's the green, have gone up more than anything else. That's largely because oil came from a real low. And in fact, if you look at the green, you'll see it gets really low, and that's because when oil prices collapse. So there's a bit of a mechanical exercise going on, but oil prices are high by historic standards. And then when you do core CPI, it's the next highest, and that's got a lot of goods in it. And the goods are where all the bottlenecks are. That's where the big supply chain disruptions are. That's where the big capacity shortfalls are. And the services is much lower. Now, the services above where it's historically been, which is around 2.5%, but not so crazy. And this is why people like me think that inflation will normalize this year. Go to the next chart. What you've got is the inelastic demand for a lot of items, particularly goods, meeting supply shortfalls. Real simple number. The US economy, as I told you, is 3% above where it was 2 years ago, and industrial output is 1% lower. Okay, just think of that. Industrial output 1% lower and GDP 3% higher. Are you surprised you see a lot of price spikes for goods? No. And when will that disappear? When supply normalizes. It is not so much that demand, the fact that demand grew over 2 years by 3%, that's not the surprise. The surprise is that output fell, and that's capacity cuts and other things. So where the reason I think you're going to see normalization of inflation is because capacity will adjust. Where the prices are high, it's sending signals we need more capacity here. It is slowly returning. Labor costs will be a bit sticky for a while, but the turnover, people leaving their jobs, will help in that regard because you can reset. I still have not heard down to the second to the bottom point, everybody saying the Fed needs to raise interest rates. And I don't understand how raising interest rates is going to unload ships faster. And if I thought the problem was demand was off the charts, remember, that's why I pointed out early, GDP is below trend, not above trend. If demand was the problem, then you would expect Fed action would have some effect on inflation. That's not the issue. This is supply. I don't know how the Fed raising interest rates helps bring on capacity. Until you bring on capacity, you'll have this. This is what happens when you shut economies around the world down. You get all types of unintended effects. Go to the next chart. This is the monetary base. You can see it was growing slowly and pretty steadily until QE 1, 2, 3, boom, boom, boom. You know, you go from about 800 billion to 4 trillion, and then you get the COVID related shutdown and pandemic injections, and you're up to like 6.3 trillion. Now, by the way, 13 years ago, it was 800 billion. Okay, so that's a bit of a growth. And that's the money that I think will chase assets. If you look at the next chart, this money does not legally need to be held in the banks. They are capable of lending this. And if you look at what happened, 2008, banks had no excess reserves. You saw as the money got injected, they held money at the Fed, had huge excess reserves of about 3 trillion. And then they started more aggressively lending as 2014, 15, 16, 17, 18. And instead of having 3 trillion excess, they went down to 1.5 trillion excess. That bid up asset prices. Then you've had the new injections by QE Infinity. And I think over the next 4 or 5 years, you get a replay of what you saw after the financial crisis. And that money goes to work chasing assets. I think the last chart here about that I'll focus on, the next one is about interest rates. Interest rates on the short end are 0.8 basis points. On the long end, about 2%. Now, let me just pause. If the short rate is 1.5% at the end of the year, okay, let's just assume it is 1.5% at the end of the year. That is, the Fed raises it by 150 basis points. Any of you who basically have a business out there that depends on the short-term interest rate rising 150 basis points to what would still be, by any historic standard, a really low interest rate. In fact, including the fact that in 2019, it was 2.5%. You've got a problem. Your business should not be so sensitive that raising interest rates back to 100 basis points below where they were before the pandemic, and at probably 200 points below where they've historically been, shouldn't disrupt business. And in fact, I think it will help business in the sense that it will reallocate capital more efficiently. The long rate is at 2%. At 2%, it's lower than it was before the pandemic. And as you can see, it's lower than a whole lot of periods where you did really, really well in real estate and where cap rates were not so bad and NOIs were not so bad. So even if the long rate is 3% a year from now, are you happy as a borrower that it's 100 basis points higher? No, but you're going to be happy that the economy is sufficiently stronger to more than make up that 100 basis points of movement. And Bruce, I think what I'll do is stop there. Well, let me just go to the last chart, if you would, the issues ahead. And if you go to the very last chart. Keep going. Yeah, there. The last chart, is Omicron the last big hurrah? That doesn't mean it disappears. I think it is psychologically. People are moving on. That doesn't mean they're happy, but they're moving on. I think you're going to see enormous normalization of capacity over the next 10 months that are going to eliminate a lot of these shortages and supply surges. I think you will see a normalization of people going back to the office. I think you will see small increases in tax rates. I would expect the upper income party before the election, they'll raise tax rates by 200 to 300 basis points. And on the capital gain, they'll probably raise it maybe 300 to 400 basis points. Those would still be well within the range of where it's been much of the time when the US economy has prospered. And I repeat, I think we've just begun the year of normalization. So with that, Bruce, I'll stop. We have about 10 minutes for questions.
Great, thank you so much, Peter. So we have a number of people who are in the multifamily space and curious to know about just general strategy. So let's say you're a multifamily investor in New York City, and that's your business. But you don't think that you can continue to afford to pay 3 to 4 cap. What do you do?
Same thing you always do when you're not willing to pay the market price, which is do something else. What do you do when the ticket price to go to the ball game you want to go to is beyond what you're willing to pay? You do something else. Now, whether that something else is moved to cities where the cap rates are not quite as low, they're low, but not quite as low, or you get a new occupation, that's for you to say. But markets work by people deciding whether they're willing to do something at quote the price, right? And so I don't view that as an abnormal challenge. I view it as a standard economic problem.
So what I'm hearing from you is a altered version of the Go West young man, which is now essentially Go South young man.
Either that, or you just accept this as the new pricing of risk in the assets you're doing.
Right. On the topic of housing, the SFR space has been heating up for a while, and as you said, that industrial has very much become an accepted and popular institutional asset class. I think something similar could be said for the SFR space. Large platforms are mobilizing initiatives to acquire existing units and also go into ventures where they're going to, pull 100 or 200 houses out of the ground for the express purpose of renting. What do you make of this?
I think it's a good business if you're at a sufficient scale to cover the overhead associated with institutional capital reporting. Or you're very, very small, one or the other. You got to be very small or very large to cover the reporting costs. It's a cash stream. It's a cash stream that has a real sector. A single family rental is not new. It goes back. I point out that my closest friend in high school lived in a rented house in Lima, Ohio. Why did they rent? They rented because their single mother, had enough money to pay the monthly, but had no money to make the down payment. And so that's why they rented. And that was back in the 50s and 60s. Nothing new. And I think the same thing is true today, that yes, there are people like military and others that do, but there are a lot of people who care about the school district, who want a yard, who want the flexibility of having their money elsewhere, that can make monthly payments but cannot do the down or choose not to do the down, the money down. And I think that's a good sector, and it will continue to be a good sector. And in fact, as savings normalize, it will go back to being a more even better opportunity that way.
We talk in the textbook about the popular interview question, the $100 million question, where MBAs or undergrads are asked by a potential employer, if you had $100 million right now, where would you put it in terms of real estate, if real estate was the constraint? Is your answer to that question any different today than it would have been pre-pandemic?
Well, the only question is, you have to tell me the risk profile that 100 million is willing to take. If what you told me is that the risk profile is relatively conservative, I'd say multifamily because fundamentals are good, and I'd say industrial because fundamentals are quite good because of the 3-to-1 factor we mentioned. And so I think if what your profile of that 100 million is I want a solid return, I'm willing to take something like an 8 to 12% return with modest leverage over a 10-year period, I'd say those two sectors. If you said, no, I'm willing to take more risk, I would then say the office, high quality office, is a very attractive sector. The pricing is still a bit challenged there. There's not the same amount of capital looking to get in. I think that sector normalizes, but the risk is much higher. That is, there is a chance that 30% of the people never come back to the office, and there's a big readjustment. So I think you want to be in the quality end, because if that occurs, you at least want to be where your downside is. My building is leased. But I think office is quite attractive that way. I like hotel. The problem with hotel is it's pretty much priced in most cases, that people believe it's going to recover in the next 18 months back to full occupancy. So anyway, that's kind of a quick. And obviously, you can always, the last, Bruce, you can always find development opportunities. You can't quite just say development, because that's way too broad, right? But
Right.
there'll always be development opportunities where you could get the higher risk, higher return profile.
Great, thanks. And we'll wrap up with this one last question, just based off of what's going on geopolitically right now. So if there is some sort of invasion of Ukraine by Russia, what do you think the impact would be on U.S. economy, the real estate market, short term and longer term?
I think it will have very limited effect long term on the economy. Short term, it will send the stock market down. It will probably send treasury yields down in a flight to quality sense. In a short term, I think then it'll adjust back, mainly because I don't think it's the start of World War III. Now, if it's the start of World War III, that's a whole different scenario. But I think it's just that it creates a lot of noise. Noise creates uncertainty. Uncertainty is bad for asset valuations, and therefore, other than treasuries. And I think that will happen. I wouldn't want to be trying to borrow and close that day, because I think it will introduce a lot of noise to spreads and financing. But I think it will not have a big impact on us, and obviously will help the fracking sector of the U.S. if that happens, because whatever already high demand for our natural gas and oil in Europe would even increase more in the short term. But I don't think it is a very important geopolitical event, but I don't think it's a very important economic event. Ukraine's just not that big, and even Russia is not that big in an economic context. It can't help, but I don't think it does great harm.
Great, thank you very much. Well, unfortunately, we're not going to be able to address all of the questions that came in, but I do want to make everyone aware that this presentation is a digest, very much a digest of what's presented in a lot more detail in the Linneman letter, which is the quarterly hard copy subscription from Linneman Associates. And more information can be found on the Linneman Associates website, along with other resources such as a free audio interview series that Peter and I did, and a video interview series that Peter did with BizNow Media. Websites are what you see in front of you for Linneman Associates and REFM. As a reminder, if you're registered, you will automatically receive an email link to the recording of the webinar in about an hour. Thank you again for joining. Thank you, Peter, for your insights as always. And we hope everyone stays safe and well, and we hope to see you back next quarter.
Thank you.